Good morning, everyone. I'm Arthi, and this is Harsha. We come from Synthesis Software Technologies. It's an absolute honor and privilege to stand in front of all of you guys today at this cross-border payments conference to share our ideas, understand the challenges, participate in various discussions, and learn from everyone.
Before we start, I just wanted to say it's so funny that we all foreigners come here to South Africa and are speaking about cross-border payments. It's just funny. And you can hear it from our accent, I believe, we Indians. Just before we start, I just want to know how many of you heard or used the word wire transfer or telegraphic transfer in your day-to-day world? All of you. It's so ironic. The first international wire transfer was done 150 years ago by Western Union. And the reason why it was called wire transfer was because it was done over wires, telegraphic network, with Morse code. And 150 years later, we're still using the word wire transfer and telegraphic transfer. A lot has changed in these 150 years. This new regulation, technology has emerged, consumer preference has changed completely. New business models have emerged. And we're still sitting with the old school names. It's ironic, it's funny, but yeah, we'll change as we change. Cross-border payments currently is at inflection point. It is a very amazing industry to be in. I think you all can feel it. The ecosystem is shaken up by competition. It's shaken up by new technologies. So today, Arthi and I would like to talk about the change, a change to attain borderless payments. We'll talk about a $250 trillion opportunity. Sounds exciting, right? Customer journeys, pain points, what are the pain and gains, the opportunities and challenges, what are the shifting dynamics in the payment system infrastructure, the big words. Future-proofing cross-border payments with new financial market infrastructures, initiatives to realize these new financial market infrastructures. Let's talk about the $250 trillion opportunity. So Bank of England has forecasted that the size of cross-border payments will be $250 trillion by 2027, up from $150 trillion, which we are doing already across the globe, which is $100 trillion increase in just a decade. Now, what does this equate in terms of revenue opportunity? $240 billion. We're talking trillions and billions. We can imagine maybe some of you are inspired to do more business in cross-border space now. And the most interesting part is Asia and Africa are at the tipping point. They are at the tipping point. They're the hot spot with expected growth of about 10 to 15% per annum. And why is that so? Maybe you all have heard about Asia, India in 2030 being the market leader. Africa will be the market leader by 2050. That's the estimate. So Asia and Africa, this young population which is coming up, the use of technology, the use of the penetration of smartphones, the penetration of internet is leading to that surge. It's so exciting to be part of Africa at this time in payments industry. There's about 30 million Africans who currently, as we speak, live outside of their home countries. That amounts to 47 billion remittance flowing in South Africa, into Africa. Just to put this into perspective, what we have done, who are these people who are going to give the way or pave the way for the surge? We have categorized them into 3 segments. And essentially what it does is it gives you the idea of what are different flows in cross-border from a remittance perspective we'll be looking at. The job seekers, the digital nomads, and the shoppers. So the job seekers essentially are the people who just move across the continent in search of better work and life. But they have their better halves, their families living in the home countries, and they have the need to send money. What do they use currently? Money transfer operators, mobile network operators, the non-banking channels, payment gateways, digital wallets. But still, they have a very high pain, a pain of high customer fee. Like the fees in South Africa is higher than global average. It's about 6 to 10% approximately, which is like 3% is the standard, which is way higher than the global average. Who are digital nomads? I think it's like Kim, me, Arthi. We are the digital nomads. We just like to experience different countries. We like, okay, we can work from anywhere, so let's do that. What do we use? We have trust in banking systems, and we have affordability, and we have the bank accounts. We have the documentation to open the bank account. So we actually keep it in banks. We actually keep all our finances in check in banks. We trust the banks. But despite, and we're ready to pay the high fees. Despite paying the high fee of banking, we really don't get the near real-time, leave alone real-time, near real-time availability of funds. We don't get the transparency of what does my fee look like. We don't get, so basically, Swift introduced a concept called Swift GPI in 2017, which does give a way to banks to allow or give transparency or enable transparency for their customers, but it's still not sufficient because it will only achieve its goal when it achieves a critical mass, which still is far away from where we look at. The third category is the shoppers, the shopaholics. I'm sure the women, the ladies in the room, you must have shopped with Shein or Alibaba or the likes of those. What do we use? We use card network. So MasterCard, Visa Direct, or Union Pay. These are kind of the card network which has given an amazing option for customers to actually shop anywhere across the globe. And the best part is the payment actually feels like domestic payment. So you really don't realize whether you're making a transaction cross-border or you're making a transaction. Like how many of us really know that the card transaction which we make in foreign countries or the card transaction we make at foreign websites are cross-border transactions. They are cross-border. So these companies have given away and done amazing job of contextualizing payments for the customers. But the pain point for shoppers is not all banks debit card is supported internationally, and credit card penetration rate in emerging market is quite low. So let's face the challenge. We are in the emerging market and we need to solve for the emerging market, and the credit card penetration is not good enough.
Now that we understand the customer journeys, if we consolidate all these into biggest pain points, these are those, right? So if we start with speed, yes, over 50% of retail and corporate clients say speed has been their biggest challenge. And why is there delays? This could be because of multiple intermediaries and correspondent banks involved, and different operating hours, there's cut-off times, and public holidays. Even when I send money, if there are public holidays, I know it's only going to reach sometimes even after 4 or 5 days because of different festivals and public holidays across different jurisdictions. Then is your cost, like Harsha said, it's estimated to be anywhere between 7 to 10% of the transaction value that goes into fees. So why is there high cost? Why is there high fees? It could be because of SWIFT fee, foreign currency conversion fee, regulatory costs. All of these can quickly add up. And on top of these, the legacy infrastructure that the banks use and multiple hops, like we said, all these can contribute to high fees. There's a United Nations Sustainability Development Goal that says the average cost by 2030 for a $200 remittance cannot be more than 3%. But the question is, how are we going to achieve that? Then transparency. There's no real-time traceability. Even when I make payments, I understand the banking world, but when I initiate an international payment, all I know is it'll only reach third day in my India beneficiary account. But I have no way of tracing where is it stuck, where is it flowing. That view I don't have. And imagine the side of the migrant workers, they don't have any understanding of banking, yet they have to wait. They can't send money back home when there's an emergency. Then regulation. Because of the complexity and risk involved in cross-border payments, there's a high need to implement regulatory checks. But it also adds to the transaction delays, sometimes declines, and then you have to do manual repairs in order to fix those transactions and resend or reprocess. There's also AML and CFT and sanction rules that's also put in place that can add to the complexity. So we'll see how do we address all these challenges. And what's the market and opportunities that we are presented with? It's estimated that over 95% of the cross-border flows come from business-to-business payments. That includes your border trade, import exports, gig payments, supply chain, all of those. Then is your e-commerce and internet penetration. All of those come and contribute towards the C2B flows. Then because of, we have spoken enough about the migration, global migration across the world, all of those come from the C2C flows. When we talk about cash, specifically if we zoom into Africa, cash has been digitized in the form of mobile money even before the bank accounts. It's said that it's the first account for a lot of Africans before they even opened bank accounts. And we spoke about high internet penetration. So all of this, what is it presenting? This massive growth opportunity for international and global companies. So I read an article that said when Uber was introduced in Kenya back in 2021, because M-Pesa was so popular in the country, whoever's using the Uber service, they directly tried to pay the driver using M-Pesa without involving Uber. So whatever the commission that driver decides to give Uber, that's what gets to Uber. So this shows that if you introduce payment services, if you don't provide the right options, then you can't have the right digital exposure. So even another classic example was Spotify. There were even users that made memes that said, we were using VPN long before you introduced Spotify in Africa. And similarly, Glovo, a delivery-based platform, all these companies, they want to expand businesses in the continent, understanding the young and digital savvy market, but it's important to understand what payment options, what digital payment options can we introduce and make it feasible for this market. So now we understand the consumer preference. That's just straightforward. They want to be able to make payments or use the services that's available, but what options do we have? Let's see from a technology and regulatory perspective. From a technology perspective, we all have spoken enough about APIs, but what APIs has led way for? Open banking. And this is the time we speak about the banks and non-banks involvement. The non-banks involvement has given space for value-added apps for customer experience, and the banks have started to realize that as well. So it's important that the banks and non-banks collaborate in this space and provide better experience for customers. Then you have embedded finance, distributed ledger technology. So there's understanding that it's quite popular these days, the distributed ledger technology, but the regulatory bodies are also coming into play. SWIFT, Bank of International Settlement, they all understand the importance of regulation so the customers can have a safe and secure way of transacting. From a regulatory perspective, also ISO 20022 has been the talk of the town. The migration has started from March 2023. 15% of SWIFT volumes are already flowing through the new standards. It's estimated that by 2025, 80% of RTGS volumes will flow through the new standards. Then there's CBDCs, the digital currencies, right? So again, the central banks has realized the importance to regulate this. 25 out of 130 countries in Africa are exploring CBDC options. And why it's important? It eliminates the need for correspondent banking and payment processes. So it solves for the cost and speed pain points that we spoke about.
Those are the great technologies. So we have the buy-in of regulator. Regulation has come to party. Technologies have come to party. And consumer behavior, we can see if we don't fulfill the consumer behavior, the changing consumer behavior, we're going to be left behind. So let's talk about the roadmap for enhancing cross-border payments. In 2020, G20 countries, which South Africa is also part of, along with Bank of International Settlement, BI's Innovation Hub, along with FSB, the Financial Stability Board, and few other standard-setting bodies came together. They put together 5 focus areas with 19 building blocks and with a target date in mind of 2025 to enhance the cross-border payments. And the focus areas which you're seeing on screen, these are the focus areas which we will be touching upon in next few slides. Let's talk about the first focus area, which is existing payment infrastructure. Why change everything when you have something which is working? We just need to enhance that. So the first point which was raised was PVP adoption, which is payment versus payment adoption. Payment versus payment basically talks about if I do not get, I do not pay. So atomic settlement in wholesale forex. Why are we talking about wholesale? I think Kim also touched upon this. Because wholesale forex is what provides the liquidity, or what it does, it fuels the retail and the commercial transactions. So PVP essentially says that if in a forex transaction, a paying party only pays the currency it owes when it receives the currency it gets. And PVP essentially this concept was introduced around 50 years ago, reason being because of the Hertzstadt risk. What is Hertzstadt risk? Hertzstadt risk essentially stems from a failure of a bank, a German bank, which was called as Hertzstadt Bank in 1974. This bank essentially, because of US dollar liquidity and US dollar volatility at the time in 1973 and 74, the bank incurred huge losses, and it wasn't able to settle the currencies which other banks wanted it to, and the Hertzstadt Bank owed US dollars. So the losses which it incurred actually exceeded the capital it had, and it went bankrupt. And it didn't only impact the bank, it impacted all the transacting parties or participants which were transacting with this bank. And this was one of the most significant player in the wholesale forex. This gave rise to, this was an aha moment for the regulator. And they said, okay, we need something. We are sitting at the edge of decline where you'll see it is a massive, it could be a massive problem. So they introduced PVP, and funny enough, the PVP is currently being adopted in the developed economy, but emerging because of lack of infrastructure or unavailability of the settlement infrastructure or currencies with the digital, the emerging currencies. The PVP adoption is quite low in the emerging countries. So we need more PVP adoption, payment versus payment adoption. Let's talk about direct access to banks and non-banks. So yes, banks are the direct participants. Fintechs scream about it always, but why do we want fintechs to be direct participants? Yes, regulation has to evolve to be able to cater for that, but if we actually give direct access to participants who are participating in a transaction chain, it actually reduces the transaction chain. The biggest problem of a cross-border payment is the number of intermediaries which actually are involved in a cross-border transaction. And this direct access will avoid that. And it also will avoid the pre-funding and the liquidity need which is needed because of the multiple intermediaries. So essentially, your cost of a cross-border transaction, the delays of a cross-border transaction, it is hitting the nail on its head, and it's actually solving for multiple pain points which customers face. Let's talk about the overlapping operating hours. So currently, like Arthi mentioned, all the different jurisdictions, because of time zone difference, have different, the RTGS systems work differently and in different time zones. So if I'm making a transaction to US, and because US is 10 hours ahead of me or behind me, then I will, if my actually bank still can do a near real-time transaction, the transaction stopped at US. So the more intermediaries, the more delays it creates, and if the operating hours are not aligned, then essentially it actually leads to those challenges. Now we talk about mega financial market infrastructure. Okay, let's look at, we're still using the existing systems, we're just linking the existing systems to create a broader market infrastructure. So just imagine the first point, linkages between domestic and domestic instant payments, and the last point, which is instant payment schemes as channel for cross-border transactions. So they are kind of convergent themes. Just imagine, we all have heard PayShop, we have all heard UPI, we have all heard PIX. I think those are the hotcakes in South Africa currently, we all talk about. If we just link those domestic instant payment schemes, we really don't need SWIFT. We don't need correspondent banks. The amount of cost, the amount of infrastructure, the amount of challenges like which customers face, we can actually solve by just interlinking these domestic schemes. And it is being done as we speak. It is happening. So it's not a foreign concept. The US RTP, real-time payments, and UK RT1 are linked. And they actually avoid this whole correspondent banking model. There's another initiative between India, Malaysia, and Thailand, which is also happening. where they are trying to interlink the domestic payment schemes. 24/7 RTGS availability. I think this speaks to itself. Like RTGS systems essentially are necessary for cross-border transactions. If you make them 24/7, BIs have put together a plan where either you can create a common settlement window, which is where all the RTGS systems are basically available, or because 24/7 is currently looking unrealistic, or you can basically look at which window most of the cross-border global transaction happen, and you create that as a RTGS window. If you can just make that happen, it can actually eliminate a lot of challenges.
Then under the new payment infrastructure focus area, the building blocks that were put out were multilateral platforms. So what is a multilateral platform? It's a payment system that is extended to multi-jurisdictional, right? So the action item that came from CPMI, IMF, and World Bank for this building block was to say they have given or proposed two approaches, the growth approach and the greenfield approach. What is the growth approach? Let's assess the existing multilateral platform and extend it to multiple regions, currencies, and participants. Then under the greenfield approach, we said let's come up with a new platform, new multilateral platform that can be extended or potentially global, that can solve for both technological and regulatory concerns. Then under global stablecoin arrangements, again, we have all understood the cryptocurrencies and distributed ledger, they're all gaining popularity. But why stablecoins are more popular is because it's backed by fiat systems or fiat currencies. So the Financial Stability Board issued a public statement that said there are ongoing legislative efforts for payment stablecoins, and this will safeguard from financial stability risk. So it's important to come up with well-designed and risk-managed stablecoin arrangements that can enhance cross-border payment flows. Then under the CBDC design, okay, we all know about central bank digital currency. It's backed by the government, central bank. Many central banks are either in developing phase or trialing out CBDCs. The important use case specifically is cross-border payments. This is because if you can solve for it within the domestic region, you can easily extend to cross-border flows. Then under regulatory and supervisory oversight, there are two important building blocks that's being explored, starting with the AML and CFT rules. Again, the Financial Stability Board did a stock take of existing international standards, principles, and guidelines, and they said or laid out 3 specific policy areas for improvement. And starting with supervision of banks and non-banks, what risks they come up with, what activities they participate, and how do we apply consistent rules for all participants in the same value chain. Then transparency of information for users when they initiate payments. Then cyber and technology risk regulation. And what has been also prioritized by the FATF is digital transformation of AML and CFT rules. Then it should be noted that the rules are, we're not saying the rules must be taken away, but it must be consistent and proportionate without generating unnecessary frictions in the payment flow. Then under KYC and identity information sharing, this is to provide a set of policy options to address gaps in coverage, access, quality of digital IDs. So the work that's ongoing in this space is to say, let us assess the status of digital IDs all over the world, adopt legal framework to use these digital IDs, and how are the payment service providers are using these digital IDs in the payment flow. So these are under regulatory, and then let's see the data and market practices focus area. So under this, specifically on the ISO 20022 messaging standard, yes, we all widely adopting, but are we understanding what use cases that it can solve for? Because I've worked with some of the major banks, because to meet the SWIFT deadlines, what they are doing is just putting a transformation layer in front of their legacy system to just solve for transformation. But when you get get the message back, are you really using the information or the data that comes in these ISO 20022 messages, and see how you can leverage of them. You can do valuable customer insights, avoid payment exceptions and investigation, the manual compliance checks and manual repairs that we spoke about. So it's important that what data it comes or it offers in this ISO 20022 messages, and how do we leverage of those, the use cases that it brings, that's where we need to focus on. Then harmonized API protocols. So yes, there's wide adoption of APIs, open banking, all that is fancy from a technology perspective, right? But there's still fragmentation of protocols and different standards of these APIs adopted in different jurisdictions or different parts of the value chain even. So this initiative is to say, how do you bring this all together and come up with standardized initiatives of APIs? We spoke about interlinking faster payments across different regions. And how is that done? By leveraging APIs. Then unique identifier for proxy registry. This is important because we spoke about digital IDs, right? Yes, every national or region has their own digital ID, but this initiative is to say, how do you bring together or even potentially come up with a globally unique identifier, and then each region or each within the country, you can have your own national database, almost like a proxy identifier that links to this global unique ID. This will solve for the KYC and improved regulatory rules if you have one unique identifier. Yes, it's not easy, it comes with its own challenges, but it's worthwhile exploring if we think about what is it solving for.
It's almost like to say, if we all had just one passport and we can travel anywhere in the world. Great, so let's talk about, we spoke about all the building blocks, but there's really a concept which has emerged and has been tested, has been piloted, which, and it's called as the conceptual design of a new financial market infrastructure. So this is a brainchild of Citibank, and they didn't do it independently, they did it with regulators. It basically is a shared ledger for digital currencies that is always on, programmable and multi-asset. And I'm reading the statement because it's important. This is basically this ledger essentially, or this network, what it does is it takes the best of both worlds, the best of technology and the best of regulation. So what it says is this concept, you can tokenize your central bank money, which is your CBDCs, you can tokenize your digital bank money, digital money, and you can tokenize your commercial bank money, and those you can actually transact using those money over distributed ledger. A new distributed ledger was conceptualized for this. They called it Embridge Ledger. All it does is the red portion which you see here, this is the network. Outside of the network, the banks or the participants just have to ensure there's enough liquidity from a wholesale CBDC perspective so that a transaction can go through. The red part of the network, which is self-governed, independent network, automated network using smart contracts, will do the KYC, AML, CFT checks, and the red part of the network essentially will allow for atomic settlement of the currencies. So you don't have to actually wait, and you don't have to actually I'm just getting conscious of time because you're standing. So you don't have to actually, this is all gonna happen, in a single ledger, atomically as a single transaction. Just in the interest of time, I'm gonna move forward quickly. These are other initiatives in similar lines. Project Embridge was done very recently, like a couple days back. And it was also aimed at how do you actually eliminate the correspondent banks. You can read about it. The paper is released and it is available at BIS. And interestingly, Project Dunbar also tested multi-CBDC platform where each bank, even if you're not in the jurisdiction, for example, Australian bank, which is not in the jurisdiction, can also hold South African tokenized version of South African rands, so CBDCs of South Africa. And that eliminates the whole need of correspondent banks. And if correspondent banks are gone, I think half of our problem is already solved. So those two reports are available at BIS for you to read. We just want to close off with something. which is the bigger purpose. I think we living in a capitalist economy, so we all are in the game of business, so we want to make money, but I think the bigger purpose is easing the life of customer. So how do we actually ease the life of customer? I think we don't really need to think about competition. There's a very strong need move from competition to collaboration. I think that is what, if we actually just think about not cannibalizing each other's business, just come together to solve the bigger purpose, I think the problem will be solved. Thank you.
Thank you.